Welcome to the Phuble podcast, the podcast where we talk about all financial markets around the world. I'm Philemon Viennes, and this podcast is sponsored by Phuble, the social networking platform for any and all investors. It is Sunday, December 8th, so we are going to be discussing the previous week in the financial markets, mainly here in the United States. The Dow Jones finished the week at 28,015 US dollars. The Nasdaq finished the week at 8,656 US dollars, and the S&P 500 finished the week at 3,145 US dollars. This was a complete turnaround from about 2 weeks ago. This past week started off pretty rough actually, and then later on in the week there was a huge bounce back in the stock market. The gains in the US stock market was mostly attributed to the jobs report for November. The unemployment rate decreased to 3.5% from 3.6% in October. Non-farm payrolls increased by 266,000 for November. Average hourly earnings rose 3.1% year over year. Economists estimated that there would only be an increase in 187,000 non-farm payrolls for November and a 3.6% unemployment rate. They also estimated that there would only be a 3% wage gain. So the jobs report was very, very positive for the United States. There was a 0.1% drop in labor force participation, but healthcare, leisure and hospitality, and professional and business services increased their payroll substantially for November. So overall here in the US, there was a very positive week. All the indices benefited off of this news. This is a sign that the US economy is doing well actually. I would not get so positive over these numbers. First of all, the GM strike, that's General Motors, workers strike ended in the end of October. So for November, about 41,000 workers were brought back on payroll. That had a substantial effect on this jobs report. About 41,000 jobs from the November job report was attributed to that end of the strike for the workers at GM. Also, this could just be that businesses are forecasting that consumers are going to still buy, which is why they're hiring more individuals. This happens normally. Businesses use the past months to predict their future revenues, and if their past months are doing very well, they're going to end up hiring more people because they don't want to have a shortage on their staff, which would lead to decreased revenue, because if they don't have enough people supplying the services or the products, they're obviously going to run into a shortage for their consumers. So they're anticipating that consumers are going to still buy toward the end of the year and going into 2020. I wouldn't be so sure that the US consumer has been very strong, even more so the past year. There's going to be a time though when consumption here in the US slows, and basically the US consumer has been taking over the slack of the rest of the world in buying products and services. Once that slows, you will see a layoff from these companies. I don't know when that's going to slow. I would not bet everything on the US consumer right now. The world economy is going into stagnation right now. I don't think the US economy is going into stagnation right now. I think there is going to be a point sometime next year where it does, and then you'll see a decline in growth. Moving on to oil, WTI finished the week at $59.20. Brent finished the week at $64.39. Saudi Arabia announced that they would cut oil production in the previous week. I'm not sure if the market requires that Saudi Arabia cuts output more than Saudi Aramco requires that Saudi Arabia cut output. The Saudi Arabia government is basically preparing that the rest of OPEC also cut output. There's an incentive though for other members of OPEC to not cut output. When Saudi Arabia cuts output, oil prices rise, which means anyone who doesn't cut output is going to benefit from that rise in oil prices. Right now, oil is still between that $55 to $65 range. I once again do not think that Saudi Arabia is going to be able to really drive up prices past 70. You might see a little bit of fluctuation above 65 US dollars in the coming weeks, but I don't think that they're going to be able to cut enough production to drive the price of oil above $70. Switching to gold, COMEX and the spot index are still below 1500. COMEX is at 1,465 US dollars. The spot index is at 1,460 US dollars. Gold is suffering from the gains in the stock market. Like I mentioned before, investors are going out of gold and probably into the stock market or into government bonds. Those rates have actually increased, so it would be beneficial for investors who are looking for yield to go into bonds right now. I still think gold is going to be a great investment in the coming years. I think that finishing out 2019, I'm still prepared to say that gold will probably finish around $1,500. Speaking of bonds, the 2-year bond is at a yield of 1.61% and the 10-year bond is at a yield of 1.84%. Like I mentioned before, those yields went up mildly this past week. They're still pretty low. They still have been fluctuating downward. On a 5 to 6 month outlook, bonds would probably be a decent investment, just because if there is a downtick in earnings going into 2020, investors are going to float back into bonds, driving those yields down and increasing the prices. So I would say that at this point right now, the U.S. Treasury bonds would be a decent investment. I predict going into 2020, those yields are probably going to be lower, so the price is going to be higher. Switching to one of my favorite companies, Slack. I've talked about them before. They released Q3 earnings this week for fiscal year 2020. They reported a loss of 2 cents per share. Estimate was 8 cents per share. Revenue beat on 168.7 million US dollars. The estimate was 156 million US dollars. Sales for Q3 increased 60% year over year. Slack is doing really well. Slack has 821 customers paying more than $100,000 in annual recurring revenue. That's up from 720 customers in the second quarter of this year. The price of the shares have absolutely been destroyed since their IPO earlier this year. After they released Q3 results, they forecasted that the loss of Q4 would be between 6 and 7 cents per share, when estimates were 6 cents per share. Their price is right now around $22. It got beat up pretty bad after those Q3 earnings results, not only because of that increased forecasted loss for Q4, but there is concern that Microsoft, who is their main rival in workspace collaboration technology, is stealing some of their business. Microsoft Teams, that is the Microsoft project that competes directly with Slack's application, has 20 million daily active users. Slack only has 12 million daily active users. That statistic is skewed very much so. So basically, Microsoft packages Microsoft Teams with Office 365. A lot of people use Office 365 for emails, Word, PowerPoint, the basic Microsoft applications. When you log into Microsoft 365, it automatically logs you into Microsoft Teams. So people might not actually be using Microsoft Teams that are logged into Office 365, but Microsoft counts them as using Teams, which isn't really fair, but it's justified because they're using the package deal of Microsoft Office 365, which comes with Teams. I would almost guarantee that 20 million people are not using Microsoft Teams every single day. I've used both Slack and Microsoft Teams, and from my personal experience and all the people who I work with, they all prefer Slack over Microsoft Teams. Microsoft Teams is a much worse interface, I think, than Slack. I should say that Slack has a much better interface than Microsoft Teams. They are a perfect takeover company. Like, they are an absolutely perfect takeover company. Their stock right now, even though it's been beaten up pretty bad, is a fantastic buy. They are a new company, yet they have more than 50 customers spending more than $1 million per year on their premium service that they offer. They are going to do fine in the future. They are, I think, the leading application in workspace technology. Sticking with new technology stocks, Uber stated this week that around 6,000 sexual assaults occurred in the company's cars over the last 2 years. This comes right after TfL, which is Transport for London. It's the regulatory agency that regulates all transportation services within London, refused to give Uber a new license to operate in the city. TfL stated that the company failed to verify drivers' identities and safeguard the service for passengers. Uber stock has been pretty beaten down over this news as well, especially for the sexual assaults. Just to put into context though, about 2.3 billion trips were taken during this time period of the last 2 years. So 2.3 billion trips were taken and there were 6,000 sexual assaults. And I know one sexual assault is too many sexual assaults. It is. But that is a lot of trips to manage for Uber. They need to figure out how to really prevent sexual assaults. And it's difficult. I think they're trying their absolute best to figure that out by installing like emergency services within the app. But it's tough. I mean, you're essentially employing people that you don't know to work for your company as a freelancer, so they're not employees. And then also people you don't know using your service as customers. I think on a percentage basis, that's 6,000 cases over 2.3 billion trips is actually very good. But once again, you do have to cut that number down. And also regulatory issues that they're going to run in with, especially here in the US, I think, amongst states. So whether they classify their drivers as employees or freelancers, right now they're like freelancers. They're not employees, or I guess they call them partners, but they're not employees. And I think some states are going to have issue with that. The TfL situation is just going to be a microcosm, not only with verifying drivers, but also with classifying drivers as employees or not. I wouldn't invest in Uber. It's going to be really, really tough for them in the future. A company that I do like for 2020 is Johnson & Johnson. They've had litigation issues. In 2019, they start off the year pretty poorly, but then the stock really battled back. They released quarter 3 earnings back in October. Just a quick snapshot. Earnings per share was $2.12. Estimates were $2.01. Revenue came in at $20.73 billion US when estimates were $20.07 billion US. They have a dividend at 2.11%. PE ratio is at 22. I really do like Johnson & Johnson. They have about $16 billion in estimated cost, over 100,000 damage claims. So the estimated cost of those 100,000 damage claims is about $16 billion. But their CFO said that most likely they will be on the winning side of appeals from that litigation. He also said that Johnson & Johnson will grow above the market. They are ahead in their medical device unit, and they are averagely rated right now at a P ratio of 22. They're in a really good spot. They said that 2019 was an implementation year, so they were going to experience greater costs, but 2020 would be a growth year. So, and I believe them. I think Johnson & Johnson is going to be an outperformer in 2020, and they've been a stable stock. So even if they're not an outperformer, you're still going to earn a 2.11% dividend on the stock. I like them a lot. I think they're a safe investment. I think they're not going to be exploding. They won't explode up to like 200%, but they'll get you an average decent return, probably around 15 to 20% for 2020. And that is all for the Phuble podcast. Thank you guys for watching, and happy investing.